But let's welcome on board Mr. Arnab Banerjee, the MD and CEO at CEAT as well, to talk to us about the way forward there. Arnab, hi, good to be speaking with you. Just wanted to begin by discussing the raw material setup. And I know this is something that we've talked with you earlier as well. But, at the end of Q1, you were talking about how the raw material prices could increase by 5 to 6% in Q2. Now, on one hand, while the rubber prices have gone up, crude prices have come off. Would you still stick with the view that the total raw material cost will be up 5 to 6%, or do you think there is that offset which is likely to happen?
Right. Quarter one raw material prices were about 5% higher than quarter four. And quarter two raw material prices will indeed be higher by 4 to 5% on quarter one. This is because the crude set-off has happened towards the end of the quarter in the month of September. Right now, as we speak, it is down to 70-ish, low 70s. So this benefit of the crude and the crude derivatives and therefore the raw material basket that impacts us will happen through quarter three and quarter four, not in quarter two. The natural rubber prices, domestic especially, have been very high in quarter two. In fact, in a 15-year high, it's tapered off a little bit, but still very high at 230 rupees per kg.
Q2, there is going to be an increase of around 4 to 5%. It will trickle in only in Q3 and Q4. So what could be the impact in Q3? How much reduction are you expecting in raw material prices in Q3 then?
We have to wait and see, because the drop in crude prices should translate into the drop in derivatives, which would lead to the drop in the raw materials that we consume. So pass-through will take time. Secondly, the other big component is natural rubber. These prices are still pretty high, about 225 to 230 rupees per kilo. If these stabilize at much below 200 rupees per kilo rate, then we could see overall moderation in raw material prices. Otherwise, it's difficult to predict at this moment.
Rule out a price hike, can we, Mr. Banerjee?
Yeah, price hikes will continue because the pass-through to the tires per se is inadequate if we take the cumulative price hike from April to August. We have been able to pass on maybe 4% in barely a couple of categories, but in large amount of categories, we have been able to pass on even less. The ability to pass on to OEMs been also restricted. We have not got adequate hike from the OEMs, which is an indexed hike which happens after one quarter. So we will see price hikes in the month of September. We have already taken some hikes, and there will be further hikes in the month of September itself.
So further hikes in September is what you have taken and can't rule out further. But we've discussed about the raw material and the supply side of things. But what about the demand side? Because we understand that there has been inventory buildup when it comes to the passenger vehicles in the system, especially ahead of the festive season. For the next few months, is there any sort of sluggishness which is coming in for PV ordering?
Yeah, I think when you are talking about inventory buildup, it is about the OEM stocks, the cars. So to that extent, the overall OEM demand will be flattish, but the replacement demand is not flat. We are witnessing growth in healthy single digits. And as far as CEAT is concerned, we would like to gain share in the OEM. So though the overall OEM turnover will be flat, but we expect to gain share basis visibility of the models where CEAT will get fitted in quarter three and quarter four. And replacement will keep growing. Export order basket in all categories is pretty strong. So though there's a problem, little bit of flattish growth in OEM passenger, I think overall growth outlook on the demand side, considering all business segments, is pretty good.
A little bit more about how the business internationally is moving, because you've expanded in the agri-tire, the TBR segments as well, right? In the US, what is it that we could expect in terms of progress, the kind of timelines that you may have for these plans?
Right. So you're right about two categories, agri-radials and truck bus radial. We are also quite pushy about passenger radials. So three categories and three geographies we are focusing on, which is Western Europe, the US market, and the LATAM market, primarily Brazil. Our outlook is pretty strong. Order books are good. We want to grow faster in international business as compared to the domestic business because of two reasons. One, we face all kinds of competition, which makes us prepared faster about the trends that are happening globally. And B, it is margin accretive at the EBITDA level. So right now, our saliency of international business is 20%. We would like this to be stepped up to around 25% in about 3 years' time.
Now, given the change in the product mix that you're talking about and the fact how the raw material prices are expected to move, what's the expectation of the EBITDA margins? Because if I have it right, you ended the year FY24 with a margin profile of around 13.5 to 14%. At full year FY25 basis, what could that number look like?
Well, we don't give an exact guidance, but if you see our Q1 result, where we saw a 5% raw material hike and we couldn't pass through the entire amount, the EBITDA margins stood at around 12%. And we are having a similar kind of hike in Q2. So there is pressure on margin for the time being, though the top line demand outlook looks strong.
The margins, but seems like it's going to be transient. We talked about the four-wheeler as well as the export market, but what about two-wheelers back home? What kind of inroads are you building up on that one?
So two-wheeler OEMs are doing very well. They're growing double digit. And finally, they're coming around to the volumes which are pre-COVID levels. So 2019 kind of volumes. So it went through a trough. But year-on-year growth is very good. And the replacement demand is also pretty robust, close to double digit, I must say, with rural markets coming back. So the rural market growth is higher than the urban market. Both are growing. And we have an extensive reach through our distribution network in the replacement market. We are market leaders in two-wheeler and with a significant gap with the number two player. So we would like to maintain that in the replacement market for two-wheeler and grow with the market.
Let you go. If I had it right, your FY25 Capex plan was 1,000 crore rupees and you were going to front load a large part of it. How's that trending? What's the expectation?
Yeah, I think we will be around 1,000 crores for the full year. Out of that, about 250 crores is regular Capex, which is for overhauling the equipments, etc., molds and those kind of things. 750 crores is growth Capex, which we are spending as per schedule. And the Chennai TBR plant is already under commercial production starting September. The other projects which are spread across Chennai, Ambernath, as well as a little bit in Nagpur and Halol also are on track. So we will be around 1,000 crores for the year.
And in our earlier discussions, you had hinted at a double-digit volume growth in FY25 and you were expecting exports also to grow double-digit. You're standing by that, right?
Yeah, we are still pushing for that to growth to accelerate in the second half. Yes, so we're standing by that.
So far, so good, and that's the hope that you will end the year with a double-digit growth, at least in terms of volume terms. Thanks, Arnab, for making time and speaking with us and helping us decode what's happening on the demand side, supply side, raw material and the likes.